What is going on, guys? Today we are going to be talking to you about the debit spread. The debit spread is probably my favorite options trading strategy. It just gives you such a wide range of different stocks you can play while you're trading options, because you have the ability to get closer in the money without as much risk. And in my opinion, I feel like that's the best way to play options, is by finding some of the cheapest or more cheap plays that are able to get more percentage at a much more consistent rate than if you were to buy like a $100 or $200 option contract that you would only be able to maybe 100-200%. So that's just my opinion, though. I just really like playing cheap plays that give me a lot of percentage. Like if I'm playing a debit spread, I'm looking to only pay like $20-30 so I can get a $250 to $500 gain, maybe even more. Maybe I'll pay at most $50 for like $1,000 gain if I'm just doing a debit spread. So that gets me into one of the negative parts about debit spreads, is that you cap your gain. When you're buying just like a naked call, like any of these plays like INTC or Dell, yeah, those were cheap plays to begin with, but they have unlimited gain. So if they went in the money right now, say Dell shot up like $100 tomorrow, I would make like thousands and thousands of dollars. Whereas if I had like a debit spread on a play, if the contract went up $100 above where I said it was going to, I would only make the $250, $500,000, whatever you capped your gain at. You wouldn't be able to make any more than that no matter what. Your max gain would be whatever you capped it at. So let's get a example so you guys kind of understand what I'm talking about. And I have two examples actually, so we'll go into the cheap one first. We'll go into the Apple play. And this is a $250 gain. If you've watched any of the videos I've posted before this that have really messed up audio, then you have a really good idea of how options work. And when you're buying a call, you're buying the right to get a share at whatever price if it goes above the strike price you're saying. So when you're doing a debit spread, you're actually selling and buying a contract at the same time. So you're buying the closer to the in the money contract, and then you're selling the farther out contract. And that may sound confusing if you don't understand options that well, but that just means you need to learn more about calls and puts and buying and selling them, because you don't fully understand how options work. When you're buying any debit spread, you're saying that you are buying this contract, the one that is closer to in the money. On a put, it would be down here, it would be the closer to the in the money on the put. You just have to know how puts and calls work, and you could do it in the money or out of the money, but when you do it in the money, you have risk of assignment, so you don't want to really do debit spreads in the money, although they are sort of advantageous in some form. I just don't think I would play debit spreads like that. So let's go back to the play I already have so you guys can get the visual of what's going on here. We bought this 327.5 call for $96 or 96 cents a share. What an option is, it's the right to buy 100 shares at whatever price, or sell, depending if you're doing calls or puts, or selling calls and puts. So we're buying this contract, the one that's closer to the in the money, at a higher price, but we're going farther into the chain, into the out of the money chain, and we're going to pick a contract to cap our gain and reduce our risk. And it's the same thing with credit spreads, but credit spreads are literally the exact opposite. But I have a complete different video on credit spreads, so be sure to check that out. We're not talking about credit spreads here, but just know they exist. This is debit spreads. So we bought this contract, this 96 one. Now we sell the one above it, or we could sell this 332 if we wanted a bigger spread but more risk. But by buying this contract, the one that's closer to the in the money, and selling the one above it, we're essentially saying that we think that Apple is going to go to 327.5 or higher, but we don't think it's going to go higher than 330. So that's why we're able to play this play for cheaper, because we're buying this contract at $96, we're selling this one at $70. Here, let me get you the visual here. And that leaves us with a total cost of $26, because you're buying this contract. This is one you're paying for with your own money. You're debiting this contract, and the one above it, you're getting credit. You're getting the $70 in premium because you're selling the contract. Now, what that does, if Apple goes to, say, 332, you're not able to make any more money above 330. So if Apple ends at 332.5, you can only make $250 on this contract. You can't make any more than that, because the only way you're going to get out of these plays is if you buy this one back, this 330, you have to buy it back, and then you sell the 327.5, which if I did that right now, sold this one and bought this one, I would get my $26 of credit rather than the debit spread. So that's essentially getting your money back, and that's how you sell out of it. But you also have another chance. If Apple rips up to, say, like 340 or something, you can get assigned on your 330 contract that you sold, and you get your max gain. You get your $250, but you have to exercise this contract, and a lot of brokers have exercise fees, so you got to be aware of that and watch out for that, because on Robinhood it's like $20 to exercise something. So sometimes it's better to just sell out of your debit spread than trying to get someone to assign the contract that you sold, but then you have to exercise this for $20. You can run them all the way to expiration and get that max gain, but just be aware of your exercise fees on your broker. Let's go to the Shopify one so you have another example of what a debit spread is. See, this one has a lot wider of a spread. This is a 490 to 500, so that means we have $1,000 max gain. If Shopify goes above 500, we won't be able to make any more than $1,000 if it ends above 500 by expiration. So it's pretty far out the money. We bought this and Shopify was somewhere down here in the 410, 420 range, so it's gone up quite a bit. It has a good potential of hitting, but it's very far out of the money still. But Shopify is a very volatile stock. The contracts are pretty expensive, so really, if you're not trying to spend a lot of money, the only way to get this play is by doing a spread, because it's just really hard to get a cheap play on a stocks like Shopify, Tesla, anything that's super volatile. It's just how the market maker prices these in, because they know people do these debit spreads and are trying to get cheap plays. But let's get back to this contract. So we bought this 490 call about a week ago, and it was trading for $95, but we didn't want to pay $95. So what I did is I sold the 500 contract above it, and it was trading for about $60 at the time. So the spread was about the same. This might be a little more expensive at this point by only like $5. So what selling this contract up here did was I was able to collect the premium and cap my gain at $1,000, but I was able to play a $95 play for $35, which is really awesome. And on volatile stocks like this that have potential to move like $20, $30 in one day, sometimes doing these debit spreads is really helpful. And you don't even have to do the $1,000 gain. You could have done a $250 gain for $10, and actually that's a better play because you're spending less money to make a better percentage. So keep that in mind as well. You don't have to be playing big spreads like this. I could have just kept this small, and I could have made a bigger percentage if the play actually hits. But I don't want you guys to get like super confused, because debit spreads aren't complicated. All you're doing is buying a contract that's close to in the money, and you're selling one that's further out, and you're just risking less. So I bought this 490. Let's say I buy this 490 and I sell the 292. Boom, $10 total cost. But if Shopify goes above to save like 510, I would only be able to make $250, because like I said in all of the videos, if you've watched them, options, this is your contract to buy 100 shares. So you buy the shares at $490, that's about $49,000, but you're able to sell them at $492. So there's your $200 gain, because You bought them at 49,000 and you sold them at 49,250. Or you could just sell out of the contract, and it's the same thing even if you sold the one up here, except if Shopify goes above 500, you're going to make $1,000, not 250, but you have a lot bigger risk. You have a $40 risk instead of a $10 risk. So you just got to play it how you want to. If you want to play cheap plays with higher percentage, then do that. But if you want to get the YOLO bucket out sometimes and do a $40 play, $50, or sometimes you get crazy and do a $60 play, man. I don't like playing anything over $50. So that's just me. That's just how I play options. If you can do it however you want. If you want to put in the YOLO bucket every day, then go for it. I respect that because I cannot play options like that. I hope you guys learned something in this video. If you have any questions, leave them in the comments below. Also, check out the live streams. We're live Monday through Friday, market open to market close, even on the Trading Fraternity live channel. What is it? Stock Market Live. Those guys kill it. So be sure to check them out as well. Be sure to leave a like on the video, subscribe to the channel. We have daily uploads. I want to see you guys start trading options. I want to see some success stories in the comment section. No need to rush it. You just need to be chilling, baby. No need to rush anything. Life is good, baby. Don't even rush nothing. All right, guys. I'll see you in the next video.